Okay, good morning, good afternoon, good evening, wherever you are in the world. We've got we looked at where everybody was registered from, and interestingly enough, 50% of you are from the United States, no surprise there. But many of you from different parts of the world, so wherever you are, I won't list everything, it'll take too long, but welcome to part 2 of the Trade Guider Chart Reading Masterclass. You're here today with the master himself, Tom Williams, who's on form. He's had his breakfast, he's had a nice cup of tea, ready to teach you. We've got Philip Friston, who's driven this morning down from Norwich. He's been busily studying charts and putting together his notes for you, which we're going to be sending to you. And of course you're with me, Gavin Holmes, professional trader and CEO of Trade Guider Systems International. So what's part 2 about? Well, you remember last week we opened up a fire hydrant, got you all to drink out of it. Some of you drowned, but nevertheless it was all recorded. The recording came out well. My business partner Richard actually was able, I'm pleased to say, to edit everything, and he edited it and it looks really good and professional. You'll be able to see us all interacting with each other and all talking to each other, and it's going to be a great session today. So many of you completed the quizzes, so thank you for that. We sent you some charts to look at. Yes, we're going to do that, Matt V, don't worry. Howard says Tom eats breakfast very late. Well, let's call it a late lunch then. You're right. He's like me. I don't really eat a big breakfast, but we tend to eat a nice big lunch here. So we'll call it a late lunch. But yes, Matt V, we're going to look at the charts first of all. The first 5 charts we're going to look at are the charts that we sent you, and then we're going to look at the actual charts. And it's actually quite amazing how you've all got this right. The majority of you did. 1 or 2 of you were a little confused. By the way, we're not going to go and name individuals here today. You've all sent your charts in. Thank you very much. A few of you didn't, but the majority did. And you will remain anonymous, but you'll see your question coming up, and I'm sure you'll know who you are. And the great thing is, although we did get some charts asking pretty much the similar question, a lot of the charts were very interesting, and some of the questions came in didn't even require a chart. It was just a straightforward question, so I think you'll find that interesting as well. All right then, so let me just review what we're trying to achieve from this masterclass. And this is quite important. We did go through it last week. What's the objectives? What are we trying to achieve as teachers, and what do we want you to take from this session today and from last week? Because when you put it all together, we want you to be that much more confident that you can make successful trades. You will make losing trades. That happens. It happened to me yesterday, although fortunately in the afternoon I was able to identify a very strong setup, which I'm going to talk about today. A lot of you saw the VSA Club event yesterday where we were trying to pick the market tops, which is something Tom and I are working on, looking at identifying the top, because there are times when you will pick the tops. But as you saw yesterday with my trade that I got stopped out on, the market was bullish and trying to pick a top was dangerous. So the best trade yesterday on the S&P was definitely a test in a rising market, which we saw later on in the afternoon for a nice 5-point move, and I'll show you that today as well. So the objectives, we're going to learn all the VSA principles that we learned last week. We're going to go over them, not by using the same charts as last week, but by sending in the chart or looking at the charts that you've sent us and reinforcing the principles. We're going to put those into context, again looking at background and trade setups. We're going to teach you today again how to identify those high probability, low risk entries using VSA, and again that very much is trading in harmony with the trend. We're going to look again at how to clearly identify professional distribution accumulation and know where and when to take a trade. One question did come in, I think it was from Australia actually, about is this particular stock in distribution or accumulation, and it's very easy to see if you go to the bigger picture, and we'll look at that. We want you to learn how to identify market tops and bottoms, how to understand the herd mentality and weak holders, we don't want you to be one of them, and how to avoid becoming either of those two. What is a shakeout and how to recognise and profit from this manoeuvre by the professionals. How to understand the upthrust and where to place a trade after you see this. To learn the significance of the range or spread on any individual bar and how to put it into context with the background. Understand why the background of a chart is absolutely vital to placing a trade at the right edge. So true yesterday in the intraday markets. To learn why multiple time frames are important and how to choose the right time frame for your chosen market. And this is the greatest one, understanding what is a test and the different types of tests. I can see that some of you still struggle with that concept. We're going to spend a bit of time on that today. To learn how to identify the VSA patterns as they appear and be patient to get the best entry. All VSA patterns that are seen in hindsight must be there as they unfolded. Obviously, we want to answer your questions today. Some of you will probably have questions with you, so at the end of the session, we're going to spend as much time as we need to answer all your questions. Obviously, we want you to be sure you understand the markets work on supply and demand, and obviously there will be imbalances in every time frame, and we want you to understand that. To know the best place to put a stop loss, market orders and buy-sell orders. That's a very difficult one to teach every individual because everyone's different with different account sizes, but we'll certainly relook today at some of the places to put stops. Yesterday, if you were in the VSA Club event, you'll have seen me use a tight stop loss with a high-risk trade. I took a trade at the top there, which we knew would be fairly risky, but was only immediately brought my stop to as close to the market as I could because I felt we just might get stopped out, and it's what happened, but then the opportunity came later. And then finally, we want you to learn from everybody else, and that's what today's session is about. You've sent us some charts in, and we're delighted that you have, and we're going to look at those as well. So it's a session of about three and a half hours, I would think. We did overrun by about an hour last week, so we'll try and get you out today with lots of information without completely bombarding you. All right, let's look at the quiz charts, and I'm here with Philip Friston. We had some fun with this, didn't we, Philip? Because every chart we picked did what we thought it would do. Why didn't we take 5 trades on those charts? We could have done quite well.
We should have done.
Yeah, we should have done. Right. Okay, so here was the first one we sent you all. Okay. Now, Philip, if you just refresh my memory. Now, this was a stock chart, and we asked you to identify what the principles were at A, B, C, D, and E. And then we asked you whether you thought this stock moved up, moved down, or moved sideways. Now, I've got all the results here from the survey. Let me just read out a few of them. We won't go to all of them. Well, in fact, I could read. There's so many here. They're all pretty right. Philip, let's talk about this particular stock. Now, we've got principle A, principle B, principle C. Could you just describe each principle for us at A, B, C, D, and E? And then we'll go to the actual stock, which I think was, could you just refresh my memory which one that was? I think it was...
Well, actually, it's on the top of the screen.
Oh, it's KLC. I've just realised KLC. Well, some people, I think, would have cheated on that one, but we did blank it out here, but we didn't blank it out there. But anyway, the purpose is to make sure you get the principle. So, Philip, principle A.
Right, principle A, that's an up bar. You've got a big increase in volume there, but you've got an old area to the left, which has gone up through the area that... Gavin was highlighting there. So that on its own is the one place where you can actually have a sign of strength. But when we get to bar B, sorry, I should have said that's the one place where you can have a sign of strength on an up bar.
On high volume.
On high volume, yeah.
Now this is important because a lot of people who emailed in have got this fixation that ultra high volume up bars are always weak. Well, but of course here, this wasn't weak because it was in it was absorbing, in effect, there's a clue, these old highs to the left. And there's a few clues in there, so yeah. Back over to you, Philip.
Normally, an up bar with high volume is weak, but there's the one exception, which is bar A, is what we call absorption volume. And that's where we penetrate an area to the left, an area of resistance, which is where Gavin's got the back pointer there, which is going up through that area, and it needs effort to get up through that area, and that's what we see with the volume. Now bar B, we have a similar bar, but you notice bar B is closed a little bit further down off the highs, and if you look fairly closely, that volume, that spread has narrowed on that bar compared to the previous bar. Now the volume is almost identical. It's very little difference if you look at the volume at the bottom. So we know now that on bar B there's some weaknesses come in relative to bar A, because we're now into fresh new high ground. There's nothing to the immediate left that we can see. So we look at bar B as being much more of a sign of weakness. Now we then trundle sideways for a few bars. When we get to bar C is actually a no demand bar because it's just tried to push up, it's collapsed onto the lows, there's no volume or very little volume there, and that's a further sign of weakness, and that's confirming the weakness that we saw on bar B. Now, if you just follow it along a little bit, we've still pushed up a little bit, just managed to push up a bit, which may well have been that the index was still going up at that time, and it's just followed the index. But again, the professionals are not interested in taking prices higher. we've seen that in the background, and now at bar D you've got another example where it's just pushed up, collapsed onto the lows. It's quite a narrow spread, the volume is very low, and that's another example of no demand. And finally,
no demand upthrust, really.
There's no demand upthrust.
Most people got
yes.
that, yeah.
Yes. And finally, bar E is, again, very similar. You've got very little interest there in the upside. Volume has fallen off. In fact, it's the lowest volume probably on the entire chart, looking across there. The professionals do not want to take prices higher at this stage.
So what you're saying then, let me be clear, they were bullish at this point. They wanted to make to have higher prices because they were going to distribute at higher prices.
Yes.
So there's a logic there. So basically, at this point that you're looking at the chart, which was actually, I believe, the 3rd of December. It was, and I think it was the 3rd of December. They push it up because they want to. They bought lower, but they want to make sure that they get as much bang for their buck as they can.
Yes.
So therefore, they were absorbing anyone here and saying, no, we're going to keep rallying. Now, of course, people who are locked in here are now relieved that they're seeing higher prices. But now we start to see weakness appearing on C, D, and E, which you all correctly identified. You said, yeah, that was weakness. Let's go and have a look at the actual chart now of that particular stock. Okay, and we'll go back to that particular example that we used, and of course you can now see it in its trade guide form. Okay, so we can see here a little bit of supply on these two bars, but it takes out this old high to the left. Okay, remember, weakness appears on up bars, so you don't see an automatic sign of strength there, but because you've taken out this old area to the left and you're moving into fresh high ground, even though these are weak bars, this is the start of what we call, Philip? Distribution. Right, and a question came in from Australia about distribution. Okay, now very highly likely, in fact Tom confirms there may well be another old top over to the left here. Highly likely that there is. In fact there you can see, look, there is indeed an old top. Let's just move forward here and we come into that old top to give you a clue as to what's going on. But you can see the volume here on these two bars if I look at the bigger picture. Okay, notice how this chart snakes all the way up to its top before it begins distribution. And whoever obviously figured out this was KLLC, okay, figured there was an old top there, that would be relevant to you, because wherever there's an old top and you approach it on volume like this, okay, with lots of supply coming in, if you're long, you're definitely going to be wanting to move your stop. If you're looking for options, to take put options, you're going to want confirmation that these two bars here are genuinely weak. And you get it on all of these bars as it rolls over. Now remember, we talked last week about the mushrooming over at the top. Now a couple of you were not here last week because you couldn't make it, but we did record it, of course, and you'll see we did spend a lot of time talking about weakness appearing on these up bars like this. But the best place to really short anything is as the mushroom comes over and you're in a downtrend and you start to see signs of weakness. Now, some of you asked about the signals. You say, well, look, as this market's falling, I get multiple green signals all the way down. That's because professionals have to hold the price up after they've distributed. They're not going to suddenly rush in and sell everything at once. Tom, can I ask you, when you were a syndicate trader, now you're distributing a stock to the herd, why don't you just dump it all on them at once? Why do you just keep holding the price up as it comes down like that?
Well, you had to distribute a stock. You obviously have to have bought it at a lower price. A price will eventually be reached where you want to start taking profits. And in your opinion, the market is over bought. So you start creating good news. It might be rumors, it might be some really good news, it might be genuine good news, and then you start unloading. But the amount of stock that you're holding, if you're not careful, will simply swamp the demand, and the stock will come off, and then you lose control of it because other professionals will come in and will mess up your trade. So you have to support the market to make sure the prices don't fall too much, so you can distribute more on the next wave up.
I see. So really what you're saying here, in a down move, you would expect to find professional support at price levels because they just don't want it to collapse against them.
That's right.
Yeah, that's interesting. Okay, so when we see a downtrend in place, we keep telling you this, and I was guilty of this yesterday because I was trying to pick a top, as we'll talk about later. The best place to take a trade is in a downtrend. You're looking for no demand type bars, you're looking for signs of weakness, but you have to understand that professionals will support the market before they have another wave down, which is what happened here. All right, so we've got, just to review, we absorb this area to the left. They want to get the market up, but it is weakness at the top here. It's not strength. We're in this uptrend here. Notice how as we come over to the mushroom top here, and in fact, let's just draw this on here for you. Okay, so as the distribution phase starts, we get this nice mushrooming over of the top. Okay, and a great little place. This is a little thing that we didn't talk about last week, but I found it very useful. Once you've taken out this first point of supply over at the right edge here, and you see something like that, which is a low volume up bar, even though it's showing you there's some support here from professionals, because the volume is so low and the next bar falls below it, that's confirming the weakness in that area, and it's in the right place. It's a very strong sign of weakness, and it's one you want to watch. This is very effective on the intraday charts as well as it is on the end of day charts. Now, interestingly enough, Tom and I were trading yesterday, and I actually learned a valuable lesson yesterday. We were trying to find a short opportunity in a market that was bullish, and eventually we found a bull opportunity, but it was amazing. Your brain tricks you. If you've taken a short and you're thinking short, this market's going to roll over, and suddenly you see what looks like a sign of weakness, and you get in the market and you're short, and then suddenly a countermanding indicator comes up and says, "Oh, hold on a second, there's strength here." You look at it and you say, "Oh no, I'm right. The market's wrong. I'm right. Gavin's right." Tom looked at me. "Oh no," he said, "Don't want to be short there." But I said, "I took the short back here." Sure enough, you needed to reverse your position. Tom, psychologically, how many times, I mean, that's one of the first times that particular instance happened, and when you pointed it out to me, it was a valuable lesson, something worth sharing.
Well, it will happen if you've shorted the market and you're fairly confident in your short, looking at it, thinking, yes, it looks weak, there's a sign of weakness and all the rest of it. You are then biased to the short side, and signs of strength can enter the market right in front of your eyes, and very likely you won't even see it, which is rather, even a signal might come up and you just won't see it. It's most uncanny, really. Yeah. And the reason is your brain is so convinced that you're right. It's a short. So how can the market tell you otherwise? So you have to be very, very careful of that. If you short the market and any one of these signs of strength appear, which is a down bar on volume, low volume, that's a sign of strength, even whether signals come up or not, please pay attention to it. Especially in these bull markets. You trade harmony with the end of day index, and that was slap bang in the middle of a trading range, and we had tests that we pointed out last Monday, and that would make that market bullish.
And you're going to show that chart later, aren't we? We're going to talk about that.
We can easily show that chart.
Yeah, because we're not talking about this chart at the moment. We're actually talking about the E-mini S&P and the mini Nasdaq that we were trading yesterday. This chart here, though, quiz 1, was distribution, which you correctly identified over at the top with these principles that Philip's pointed out. But this bar here, the one that has a red signal, was a bullish bar because it took out this old area to the left and the next bar closed up. Now, Philip, if the next bar had closed down on that volume, what would your inkling have been then if it had closed lower than the bar behind it?
Oh dear, that would have been weakness.
It would have been confirmed
because
weakness.
That would have then been a false breakout. And
Yep.
you have to watch for those because they will try and trick you into doing that if they get a chance.
Yeah,
To try and take the stops.
absolutely. Matt V just says here, this human temptation is actually mentioned in Hank Pruden's book, The 3 Skills of Top Trading. A nice disposition on behavioural finance. Yep, yeah, I've read the book, Matt V, and I know Hank well. It is sometimes when we think about what is a human being, or how do we trade, we are actually looking at something, and our brains are assimilating the information to make a decision. Long, short, or in fact the most important decision, don't trade. Most people forget that one. It's actually, Philip, probably the most important decision not to trade.
It is,
actually
yes.
being in the market. because most people want the excitement, don't they, and the thrill.
This is the one thing where the computer, with its logic, is so good, where it can be far better than the human brain. But there's so many other things that the human brain can do that much better.
Well, I have to say, talking with Tom there, if you look at the seminar we did Monday, Educational Mondays with Tom, I actually did take a short trade. And I immediately did see a counter-mounting signal and came out with a tick stop loss, so one tick, and the market shot up. And someone emailed me and said, Gavin, why didn't you just reverse your trade? and the answer was, the benefit of hindsight, I should have, but I was against the trend at the time. And I do, again, stress, we want to try to trade with the trend. Okay, so let's move on to the next chart, which is actually, funnily enough, the very same chart. And now this time, I wonder if anyone spotted that. We probably did, because we probably left the... we tried to help you as best we can. Okay, so number 2. This time, yep, you could see it's the same chart, but we deliberately didn't leave this on, because now we're looking at the right edge, aren't we, Philip?
We are, yes. We're
okay,
at the
so
bottom.
Philip, principle A, B, C and D. Talk us through A and B, and then let us know what happened at C and D. And then, because we did this last weekend, we didn't have the benefit of knowing what happens. So let's see what happens. Nope. Philip, over to you.
Well, we'd seen the distribution in the background, and the stock has come off, and now we're looking at the opposite. We're looking at the price having fallen. We've had a period of falling prices. We've got bar A, which is the start of the accumulation, what we call preliminary support. And then you see bar B, we've got another down bar with a fairly wide spread, it's closed off the lows. Volume there is ultra high, so there's definitely some buying coming in there because the next bar's up. And then at bar C, we've got a down bar. Volume's a bit lower, but I would say on bar C they're probably still accumulating. And then finally we go right across to bar D. We've got our old friend, the test.
Perfect. Now, Philip, just out of interest, Matt V just said, where would you exit that short position at the top up there? Well, you're looking at it right now. so let me go with the flow here. What we can see here is we've got, you can see on A and B there, definitely some buying. Okay, Philip's explained C and D. Now, very many of you, as you said, what is the name of what is happening to this stock? Now, let's just type it in. Some of you, just type in, what do you think this is called? I know many of you got this right, some of you didn't. Let's just type in, what do you think this at the bottom of the market is called? We've talked about the top, what do we call this at the bottom? There's a name for it. Well done, Evan, spot on. Okay, keep it coming. Most of you already got this right, by the way. You could call it that, Matt V, but most of you have got it. It's indeed, yeah, let me tell you, it's accumulation phase. We talked about distribution at the top. Now, the good thing about this particular stock is that this is at the right edge of the chart now. We're not looking with the benefit of hindsight. This is at the right edge. So let's have a look at what happened on this particular. And let's just use the pen here. Okay, so we notice here A and B, very high volume on these down bars, next bar up. And then we note that the market has just gone to D, which was the week before last, I believe. We're forming almost the opposite, okay, of distribution. Now, if I was to draw this and then this, and I put a little handle on the side there, Tom, you have a cup of tea now, look. there's your saucer, look, right there.
Oh, right.
There you go. Nice cup of tea for you, because that's exactly what you're looking for. Now, where's the best place to trade this? I'm going to show you. It's up above this area here. As it breaks out through here and comes and retests this line, about $31, that would be where I would be taking a very keen interest to buy this particular stock. Philip, would you agree with that analysis, and what's your view?
I would, yes. I should have also pointed out D. We've got a test there. I should have explained that a little bit more. That's a down bar, which is closed up on the highs. The important thing is it's back into the body of bar B, and you notice the volume this time is substantially lower. So what that's telling us is that the supply, which is present back at bar D, has now diminished quite substantially. And that gives the professionals the information they need to know that they can start taking market up.
Tom, with stock like this has been in a downtrend, it's basing. but the parent index has actually been going up. So this is a stock that has been acting weaker than the parent. At what point would you be interested in buying this if you were looking at this stock?
Well, I mean, if I saw a stock, there is such a thing as they call rotation in the market, where you will find various stocks under accumulation, even though they're acting a bit weaker than the index itself. But you could clearly see, as Philip pointed out, there was looked like a bit of a climactic action there at point A. It mushroomed over a bit.
It's saucered. Be clear. It didn't mushroom. It saucered.
Well, it's all well.
Yeah, the mushrooms at the top, Tom. Saucer at the bottom.
Yeah, no, okay.
Yeah.
But as Philip just said, there's actually a test there. What's that? Point B.
D.
Point D, yes.
I can't see the chart very well.
Point D.
But that's a very, very clear test. I'm surprised if there's not a signal on there. But the thing is, when a stock drops back down into the area, into an area where in the past the volume has been high, in other words, supply is present, if it drops back down into that area and the volume is then low, especially if it closes on a high like that one, then it means that the supply that was present has now disappeared or dried up. And that's all they're looking for. That gives them the okay to mark that up. They have to do that because if there's a lot of people still in there, as they mark it up, they're going to have constant people selling into their up move. Makes the move very, very unprofitable.
Tom, did you say something you thought there might be a signal on that particular bar?
I can't see it.
Well, go and have a look now.
Oh, is there?
I'll put 20 bars up for you, my
So I
friend.
can only see about 20 bars.
You say
I'm
you
sorry.
ignore them at your peril, but there it is.
Yeah.
Okay, and now it's called a basic test, sign of strength 11, and the market's gone up there.
That's the reason why that signal's there.
Yeah, it's gone up from $28 to $30.29. So
Yeah.
quite a nice little move there on that signal.
You see that constantly, time after time after time here, is when your instrument falls back down into the area, the same level or similar area where you saw heavy volume, the volume has now dried up. That means that the supply that was present has disappeared.
Right, let me just be clear here for the audience. Okay, so we're referring to these big high volume bars here, okay?
That's right.
We've got very, very high volume here, and that's important because wherever we see high volume, there is potentially supply or sellers still
It's
around.
demand and supply are all mixed in there.
There are. So you've got this bull versus bear scenario here. Now, professional money see that. That's why the market doesn't shoot up immediately. Now, sometimes, Philip, it does, doesn't it? It immediately tests and just keeps going.
It
We've
can
seen
do,
one
yes.
or two examples of that. Not
Yes.
often, but
No.
it does happen. When you see that, though, we're looking for it to come back down into this area here and test it, and that's exactly what we saw. Now, we didn't know, Philip and I, when we set this example, that this market would respond, but look at the diamonds coming into play here now. This is what I look for, okay? And we've moved up from the low here up to 30.29. Now, Tom will tell you that this often will mark the basing out or bottom. I like to see us move through, however, this is the level we were showing you earlier, which we're right on it now, look, almost on the top of that, is to break through that level and then look for a bar like that into this area, if that makes sense. Philip?
I would agree, because what you're looking to do is to take out the high of that bar that you've got marked, Gavin, to the left, which
Yep.
is the red bar with down bar with the high volume. That's the one with the first green signal that Gavin's got highlighted there. Once you take the high of that bar out, you've then taken that supply out.
Yeah, so we're
When it
talking
moves
about
up.
this bar here, that Philip's
That's the
referring
one.
to.
That's the one.
Because it's the high volume bar and it's the top of it, and we want to break through that and test the top of that area. That's very bullish.
But you notice at the moment we haven't done that yet.
No.
And also, if you look to the right edge of the chart, we've got a little bit of no demand coming in as we approach that area.
Yeah.
And the bar before the last one, we've actually got a test.
Yeah. And you see that what happens is, as you're watching this chart, if you were to just put a buy order in at, say, 31, 31.50, something like that, if the market pushes through, it'll often push through fairly quickly and take you in, won't it?
Yes.
And then we use the stop loss management system here to ensure that then you trail up. Notice, though, we haven't got any green diamonds appearing when we did that chart. None. And it's only now it's trying to break that. again, I would be stepping aside and waiting. Got some questions coming in here. Question from Bob Blake. Hello, Bob. Good to see you as ever. At previous distribution at the bottom of A, where would you have covered, Philip? Where would you have covered your trade there? At the bottom of A, of the A bar, which is on the previous one. So let's go back. So at the bottom of A here, well, actually, I wouldn't have even been trading in there at all on A. I think is that where you mean, Bob? After previous distribution at the bottom of A.
It's not distribution.
Well, no, that's accumulation here because they distributed over at the top. So here at A and B. On down bars, you've got accumulation at this phase, not distribution. They've distributed way up here, and that's why the price fell. If you look at the chart, it probably makes it clearer. Here's your distribution phase over the top. Here's the reaccumulation at the bottom here. We can tell that the volume on this bar here, how many? 10.52 million shares. And you can see the distribution phase, they got 9 million shares here and another 8 there. So there was 16 million shares there as the distribution phase went over, and they've bought back here on that bar there, they've bought back on that bar there, and they've bought back again on that bar there, and you'll probably find if you add all the shares together it probably equates pretty close to the distribution phase.
And again 2 bars before that test they were buying as well.
Yeah. At the top, had you shorted the market, very simple. If you're looking, and I always use the trending system, see this H stop in the system, and I know most of you have got Trade Guider, you just trail your stop down. Now you'll notice that on accumulation here, I would already, when I see those 2 bars, be very much bringing my stop close. But if you just use the trending system and you thought there might be a leg down, you would start to be out on that bar there. That would be where you would actually be out of any short trade on the bar of 12th of February. And the reason you would is you should by now be recognising strength. So you've got your weakness at the top here. Now they're coming to support the market here, and you'd see those 2 high volume down bars and the support, and then you'd see this testing going on. Notice this bar here. Look, this is a strong indication that after there's been supply on these 2 bars, now look at the volume there, Bob, on that bar. It's lower than all the other bars behind it. Okay, it's the jockey, as I call it. It's the little guy that rides the horse. Okay, so now there's no selling pressure after you'd seen that supply. And it's really at that point, I personally would be covering, if not exiting. What about you, Philip, at that point?
I would agree totally.
No, wouldn't add anything to it. Just that when you see ultra high volume down bars and it gets tested, you immediately say, let's take my trade off, wait for the next opportunity if you're short, and you would have made money on that trade there. But remember I trade the intraday charts a lot, and the same principles apply. Good, thanks, Bob. Okay, that's fine. I'm glad we answered that. If you come and watch us do live trading, you'll see that when the market runs, I'll try and stay with the trade where I can. Tom says I scalp, but actually I've had no choice in the markets recently because they've whipsawed. So it appears that Gavin's scalping, but actually I'm just protecting my profits. And that means that, yes, we got a nice email in today, funnily enough. We've had one of the chat rooms, there's been some discussion about Trade Guider, and there's been a bit of misconception, which I'll clear up right now, about the analysis that we have. We have different types of analysis. You have live bar or you have partial bar analysis, where you've got these yellow boxes at the top and bottom. Now, Philip developed these with Tom, and they're an early warning signal. Now, for some reason, I have no idea why, they were described as a bouncing ball. But I have no idea why. But interestingly, what did come out in the exchange through the chat room was that we use the principles to enter a trade. That's important. But just as importantly, we use the same countermanding principles to exit the trade. I.e., an example, if you're short and the market falls and a countermanding principle comes in, your short and strength appears, you don't do what I tried to do yesterday for the first time, and I lost $100, was hope that I was right, the market was wrong. Philip, what's your thoughts? Can you just explain briefly, very briefly, the yellow dialog boxes in the software here now? Because I'm trying to find one here. Look, on this bar here, look, for instance, we've got a yellow box, but there's no indicator appeared. And it does say, wait for the next bar to confirm, and the next bar closes lower. Just briefly explain why the yellow boxes are there and what's their purpose.
Well, that was developed with Tom because we wanted to put in an early warning system so that we the trouble is sometimes with these signals, if you have a signal coming up on a live bar, and the next bar goes, for example, if you take that one, which is a basic test, and the next bar is down, the signal's not confirmed. In fact, if the next bar is down in this case, it's actually a sign of weakness, because the test which was on that bar has actually failed. So we didn't want to bring all these signals up and confuse everybody with getting signals coming up and then the next bar was down. So we developed this early warning system which cuts that out.
So, for instance, here, I think this is probably going to say potential climatic action or stopping volume. There we go. And of course, it wasn't confirmed because the next bar had a down bar. So it was warning you that it just says, hey, there's a warning here that a principle may appear. Now, this therefore would tell us that volume spread analysis requires more than one bar to confirm in many instances.
Yes, and if you just go back 2 bars from where your cursor is to the left,
just there,
2 bars back,
there,
they're the first of those green arrows.
Here?
That's the one.
Yep.
That's the one. Now, you've got a green signal on there that says potential climactic action, and you've got a down bar. You have got quite a lot of volume coming in there, but it's not as high as the volume that you had on those previous up bars.
Here, in the background.
Yes, now on the face of it, there is some buying obviously coming there. I think Tom would agree there's probably perhaps one professional group might have moved in and bought there. But look at the next bar and the bar after that. The market really struggles to do anything. And then the third bar along, you've actually got an upthrust, a hidden upthrust. So despite that attempted buying coming in there was no attempt to support the market whatsoever, and it just fell off. So that must have also contained some supply in there as well for that to fall off. There just wasn't enough buying coming in there for the market to actually rally.
Gotcha. Okay. Everybody said the sound is back now. We had a sound issue apparently for a minute or so there, but it's fine now. Could be because of the internet. So
you've always got to listen to what the market's telling you. If you see a potential sign of strength and the market doesn't respond to it, there's a reason for it.
Yeah. Question from Morris is, Philip, on the last bar on this chart, which I think is probably that one, which we can't really analyse by the way because this is E-signal, but you appear to have a poor response to the no supply bar previous to it. You do have strength in the background. If you were long at the moment, if you were long at the bottom, would you move your stop to under the no supply bar? Well, I personally, actually, yeah, let me just read the whole question. If you were long at the bottom test, would you move your stop to under the no supply bar? Well, I think the question is, if let's say you had gone long on this test here, we've come up, you can't really, you see here, you have got a pretty, I mean that bar there you can analyse, it's a down bar and volume less than the previous 2 bars, and we've definitely closed higher, we can see that. But the only thing that would concern me is we're at this old top here where we've backed it. Is that the same for you?
Exactly.
We just keep rejecting it. But if we break it, sure, if you are long here, bring your stop up, but don't be surprised if it's hit because it's rejected. Now, if the indexes push up next week, you'd expect them to drag some of these stocks with them, and
yes,
it would be yeah, definitely.
But there's a dangerous area there. If to go long on that previous bar, which is a test, is probably quite a dangerous trade to take, because if they're not finished with the accumulation, they could still bring it down to one more time.
Yeah.
So you've had to run that risk. That's why, as Gavin said, it's better really to wait for that area to be taken out and then look for a test in a rising market.
Absolutely. Yeah. Yeah. Real-time data shows the same as in end of day, says Tom. Thank you. Just to confirm that. Good. All right. So. Number 3. Oh, I like this chart. this is an absolute beauty, this one. Now, I think everybody got this right. I don't think anybody failed here. So, Philip, it's not difficult. A, B, C, D, E. Did the market go up, down, or sideways? This is, I mean, even kids stuff. This is, but everyone got this right. Nobody, I think, got this absolutely wrong. So, there is a clue there. But talk us through bar A, which is obviously the highest volume on the chart, and then we look at B, where the volume is lower, but it's back up into A, and then of course we get C and D and E back up into that same area before finally on E you can see we get that lock-in. So, Philip, talk us through those.
We were kind putting this chart in, weren't we?
We had to help them out a bit, you know. Yeah.
No, that's seriously, that is showing some very good principles there. If we go over to A, which is on the left-hand side of the chart, you've got we've got 2 things there. First of all, you've got ultra-high volume on an up bar, It's collapsed down onto the low, so you've got a massive upthrust.
Now you mean the close has collapsed, haven't you? When we say
Sorry, yes.
when we say it has collapsed on, let me be very clear. A collapsing it has collapsed mean the price, the closing price is on the low of the bar. That's very significant, isn't it, Philip?
It is, yes. I mean, this is soybeans, isn't it?
Yeah.
Yeah, future. So it may have been some news has come out on soybeans the previous night, perhaps before the market opened. And at the open, probably the price has gapped up, and it's met with severe selling, and it's collapsed down onto the lows. So it's closed near the low. That's, as I say, probably a news-related item, but clearly professional groups have taken advantage of that. They considered it was overbought at that time, and have decided to use that news to take their profits.
Yeah. Now, the one of the questions that's just come in, actually, S is saying, yeah, S is Sprint Nextel, says Tom on the thing. I thought S was soy as well, depending on the thing. But regardless, let's get to the principles here.
Well,
by the way, Walt, can you see the chart? He says, where is chart 3? Can everybody see chart 3? Can everybody see chart 3? I just want to see, you should all see that on your screen. Yeah, they can. Good. I don't want to be talking about something no one can see. Okay, so going back through the principles, which are the most important part, C and D, Philip, looking at C after you've had B, that for me, I've marked the entry there in D, but we'll talk about that in a minute. Go back down through A, B, C and D, and then talk me through what's happening here, and then finally on E.
Right. Okay. Actually, looking at the price on that can't be soybeans. Looking at the price, so
no, it is a Sprint. But sorry,
Right.
soy's the next one, but don't worry, that's fine.
Well, D, you've got push back up into that area again where we had the previous selling. You notice we've got another upthrust, and the volume on that is pretty high again. It's not as high as the previous at bar A, but it's still pretty high. So again, we've got some serious selling in there. And also important, if you look 2 bars before that, you've got very high volume on that up bar that Gavin is highlighting as well.
Massive.
So there's a lot of supply coming in there. Now the market falls off, and then it pushes back up to point D.
Yeah.
Now at point D, we're back up into the area where we saw the previous supply at C.
Yeah.
But look at the volume. This time it's trying to go up on low volume. Now there's a lot of supply at C, and it's not going to get through that on low volume. It can't do, because it needs effort to push up through that supply.
Effort versus result.
Effort versus result. And if the volume's not there, it can't manage to penetrate C. So that's a very good entry point.
Excellent entry point there. And then finally we'll talk about E. Walt, can you just confirm you can see this chart now? Otherwise I'll reproject it, because everybody else has got it. So it may be your computer locked up. So just want to make sure. Okay, I think Walt's going to log back in. Good. Okay. Yeah, because maybe his computer is frozen there. And then on E, Philip, that's where they catch everybody, isn't it?
Well, it is. I'm looking back at the number of bars that's 1, 2, 3, 4, 5, 6, 7. That's pushed down through 8 bars to the left.
Correct. That's a serious sign of weakness. Serious sign of weakness because of the weakness in the background. Just looking up, Morris says here. He says, Philip, this is for you. There is also a nice bull move that developed from the beginning of November with a high volume breakdown of the downtrend and no supply down to the... Well, let's have a look. Let's go and have a look at this. Let's look at the actual chart. And here we are. And here's all the principles. Okay, now we can see here, if we go back to the slide, 29th of January was one of the... This was the bar we were looking at. It even actually produced one of Tom's indicators that we don't actually see all that much, but they're very, very strong. Tom, sign of weakness 58, a trap up move. I mean, there's lots of weakness in the background on this chart. And then it sort of pushes up on this daily chart of Sprint and then whacks back down really hard on a big high volume bar. Talk us through it. What's a trap up move?
Well, I can't see the chart. Where exactly is it?
Where I've got the highlight. But don't worry, just talk about the principle, don't worry about the chart.
I'd like to see the chart, though.
Okay, well, let me put 20 bars up and see if you can actually see this.
And remove the dialog box.
Okay, just bear with me. As you all know, ladies and gentlemen, Tom is losing his eyesight a little bit, so we've got to get 20 bars up so he can see. There it is, Tom.
That's the one.
We're here.
Yep.
Well, it's a trap up move. Is that obviously it's driven up to catch the stops, mislead as many people as possible. It's very devious. They do this deliberately. Look, they mark it up, then a quick plummet down, close on the low. There's massive volume there. That volume would have appeared on an up move there, and that's produced that automatic signal. That's done deliberately by the people working behind the scenes on this, and that's how it works.
So basically here, you've got the weakness here. They know the market's weak.
Of course.
You've got supply coming in. They hold the price up, and then it sort of tries to gun up to the high of this close. So it pushes up through the close of this bar. The breakout traders think, oh, look, it's going to go up. And then just as the buy orders come in, bang, professional money sell it, takes out a lot of the old lows here. And then, Philip, we've actually got a principle here on this bar. After this supply, they try and test it, and look what happens. It comes off. That's a principle in its own right, isn't it?
It is. That's a sign of weakness too.
Even though it's got a green signal on it.
Even though it's green signal.
Failed test. No.
It's a failed test. The signal is correct because it is a no supply bar,
Yeah.
but it's the next bar closing down that makes that a failed test. That's the significant one.
Absolutely. Yeah, it
If
does.
you look at all these blue bars here, which are up, no demand.
Yep. Exactly. That last one before the trap up move is definitely no demand up bar.
Yeah.
So tell me about it.
Yeah, Matt V makes a good comment here. He said, Philip, when they've locked these people down here, the next bar closes up on quite high volume.
Yes.
He said, is this designed to anybody that is long here? They give them a bit of hope on that bar by holding it up and saying, well, don't worry, it's not going to fall. And so they actually hold the price. That's cunning.
Yeah, that's a very good point. Yes, that's
It's very
true. They do.
devious.
And you
It's
notice
devious.
hardly gets up at all. It doesn't even get up to the halfway point on the previous bar either.
Yeah.
So they're capping it on there.
Yeah. So when you see a wide spread down like that, after serious weakness behind you, if you're in a long position, you really, really want to be looking to close out or bring your stop up, because that is a serious, very serious sign of weakness there. All right, let's move on to the next chart, which is chart 4, and hopefully Walt is back now and can actually hopefully see the charts okay. So let me know, Walt, if you're back and that you can see the charts. Just want to make sure that you're not missing out, although we are recording this, of course, so there won't be an issue there. So we've got A, B, C, D, E, some lovely principles on this chart, okay. We actually left the JBHT chart on here so you could see it. Philip, again, over to you. Talk us through what happens at A, B, C, and then there's a great place to buy this particular instrument, and I'm going to show you where that is on the actual chart.
Well, you've got a period of falling prices before you get to bar A.
Yeah.
And at bar A, we've got a down bar after that period of falling prices. The volume is ultra high on that bar. It's closed in the middle. That's significant too. So there's definitely some climactic action in there. Moving across to bar B, we've got a down bar. It's closed in the middle. It's quite a narrow spread, and it's fairly low volume.
Yeah.
Compared to bar A. This is the important thing. We're comparing the volume on bar B to the volume on bar A.
Now let me repeat that, because we keep talking about this. We're talking about bars behind us. And now we're saying we're looking at bars at the right edge and comparing the volume now, not necessarily just the bar, but the actual volume and what the bar does on that volume.
That's right.
Relative to the bar behind it,
Relative
or the
to
bars behind it.
Yes.
Okay. Back over to Philip.
Now, when we go, that, as I say, is a test, and there's a response on the next bar, but it's not particularly enthusiastic because it's quite low volume. So what they want to do is to just take out a few more stops. So they're crafty, because bar C, we get a little shakeout, and that's just designed to take the price down below the low of bar A, take all the stops out,
Which it does. Yeah.
and then it bounces up and closes up near the highs.
Yeah.
And that's the purpose of a shakeout, to shake out any remaining weak holders.
Right. Now, I want to bring Tom in on this. Tom, when we see shakeouts in the market, and the market is pushed down to a new low, and usually this will be on some sort of news, probably bad news about some instrument. This is a very common tactic when professionals are bullish. I think one of the most famous shakeouts we saw was on 9/11, just when the markets opened. Can you just describe in detail for us what is the shakeout, what is its purpose, and actually you can talk about the seminar we did in 2002 where we talked about that, what happened when the market opened just after 9/11, and what were the newscasters telling us, and what we probably should have they been telling us?
Well, basically a shakeout is a deliberate move. It'd be in the cash market where they can mark the market down quite easily when market conditions are right. They've accumulated, they know the instrument's strong, so they mark it rapidly down, probably on some bad news, catch all the stops, shake everybody out. Just before the up move, even Wyckoff himself called this a springboard, I believe. But we've never really called our indicators springboards.
Erica here, Tom, just says the same thing. Erica Rojas says, Tom, she said, doesn't a shakeout equal a springboard? Well, you've just said it. So it's a couple of Wyckoff
perfectly right.
Yeah.
But we've never used those words springboard. We tell you what it is. It's a shakeout. It's done deliberately there to shake you out. As many people as possible. Catch stops, of course. Encourage people to go short. Panic those people that are long into thinking the market's going to go. They will cover. And so it's very profitable to have that. Now these, I noticed just now I'm thinking, when you see these kind of moves taking place, especially down moves, very often you may get one dramatic down bar, yes, but most of the bars are down fairly gently, and often you get an up bar, giving hope to those people that are locked in at higher prices. It's almost like a sheepdog rounding up sheep. If you watch it on TV, they're very clever, the sheepdogs. They don't panic the herd. They round the herd up. They keep away from it. They don't bark or anything or start snapping.
That's true.
They keep well away from them, keep circling them until the herd goes in the right direction. That's what the professional side of the market wants. And that's in fact what they do. You look at these down moves and you'll see that. But all bearish down moves are hallmarked by no demand up bars.
Chris just said that, and we'll have a look at this one, Chris. Make a note of that, and I've got an ASX stock to look at, but we'll have a look at that at the end. He says it's a Commonwealth Bank, so if you can type in the symbol, Chris, and by all means we'll have a look at that. Tom, we did a seminar 2002 at the I think it was the Society of Technical Analysts in London.
Oh
wasn't
yes,
it?
yes.
And in it you actually showed the chart 9/11.
Yeah.
Now, can you describe, because I remember the news at that time, it was terrible, obviously.
Okay.
And of course the market plummeted. A lot of people at that time were actually long and suddenly panicked. Talk about what happened there and, you know, why the market became bullish.
Right. We'd been in a substantial bear market, I believe, for up to 2 years previously. Now these markets will climax on the downside into a selling climax on some sort of bad news. That's how it works. Now, of course, we don't want bad news like 9/11 with the Twin Towers being crashed into by aircraft. That was really, really bad news. In fact, it was so bad that they closed the market up for a whole week. But when that market opened up after a week, it plummeted further down. And, of course, there's no news in good news. So you saw on the television, you saw the male presenter and the female presenter sitting there with grim face, looking at the camera, telling you how many billions of dollars have been wiped off the value of the shares. And more bad news. You have guys in pinstripe suits who talk very well, seem to know what they're talking about lower prices are inevitable. They show you pictures of the President of the United States telling you that there's Al-Qaeda cells everywhere. You're either with us or against us, and all this bad news. Now, that's fine. But if you look at the volume was massive. And if you look at where the market closed, I think it closed almost in the middle on that bar. Now, the thing is, why I always say that the news is misleading, and I've never heard the truth on TV, is simple. What they're telling you may or may not be totally true. But what they don't tell you is if they'd have finished up their broadcast which said, however, listeners, don't worry, because we have people on the floor of the New York Stock Exchange and they're telling us loud and clear, which they'll know perfectly well what they're doing, is they're buying everything they can get their hands on. This will make the market a strong market rather than a weak market that all this terrible news is inferring. And that's exactly what happened. They never tell you that.
No, well, they
They never tell you the professional side would dive in when the prices are basement value, whatever they call it.
Well, I mean, interesting, Tom. While you're talking, Chris out has picked an Australian stock, CBA, and in it he says he was talking about some shakeout. Well, there's probably as good an example here as you're going to get. Look at this. Now, I haven't even looked at this stock, so I know nothing about it. But we can see we've had a period of plummeting prices, as you can see here. Okay, so you must have a decline. Now, when I tell you to look out, and Tom tells you to look out for Shaq O'Neal, you know, the baseball player that stands out. Well, look at the volume on that day. Look, 55.06 million shares, and that was on my birthday in 2008.
Yeah. And look how narrow that spread is.
Yeah, and the spread on the bar. Now, this is a really good example here. The bar closes lower than the bar behind it, as you can see. So the close on that week there would have been some news on it here. It would have been bad. $28.150. Okay, so it came right the way down on the close. The next week now, it closes at 27.8 Aussie dollars. Look at the spread and the range now. This is, Tom, this is almost the opposite of the end of a rising market, isn't it?
It is. Well, what I can see in this chart, the news must have been so horrendous after a downfall.
Well, it's my birthday, that's probably what it was.
Yes. It's so horrendous, whatever happened there, is that they accumulated very, very quickly. Is this a daily chart?
It's actually a weekly chart of this stock because I wanted to show a bigger picture here. But you know, again, I didn't pick. This is one that Chris picked out, and
okay, but they're still accumulating very rapidly. And if you look to the right, there's a bottom reversal or a springboard or shakeout.
Right there. That's a great
you can
example.
See it quite clearly.
Eric is asking, would that be classed as bag holding? Have they opened their bags? Or
that's not bag. That's a shakeout.
Right.
2-bar reversal.
Yeah, just there. What about behind now on this widespread down? It didn't gap down. I mean, ideally on this bar here, if this had gapped down, the volume was that high and the spread was a bit narrower, Philip, that would be bag holding, wouldn't it?
Yes, it would.
And what's bag holding, Tom? Because some new people here. Suddenly some news will come out, oh, this particular stock, it's terrible. It's probably going to go bust. Goldman Sachs, the US government are going to take over this bank. And suddenly the price absolutely plummets. It gaps down on a day or a week, and that's it for the person that's holding on to that stock. They've had enough. What happens then? The professionals do what?
Well, the professional money waiting on the sidelines to pick up bargains are so happy that literally, the best way to describe it is they got a bag, they hold it wide up and say, okay, if you don't want it, we'll take it all off your hand. Thank you very much for letting us buy all this at these rock bottom prices. And I'd be surprised if an automatic signal doesn't appear. And when you see that, that's almost guaranteed to be the low of that instrument at that time for some time. No, it's the opposite to the end of a rising market, which is interesting.
Yeah, and now Philip, if I drew, you see this big wide spread down here?
Yes.
And then we've got the volume here, of course. But the market comes up and takes out, this is where they try to support it. Now, I can see a nice entry there, and I'm sure you can too, but would you agree that actually where Tom's signal is here, this is an interesting one because it's not a test because the volume's a little bit too high. It's almost, though, it's more buying on the down move. There'll probably be some news on that day as well, or that week.
It is, yes, that is clear buying coming in there. The price has fallen, but they're not letting it fall very far.
Yeah.
And they're supporting it every time there's a seller order coming in there, they're buying it. Hence the very narrow spread.
So you've almost got the opposite theory here, and this confuses most. So I'm going to spend a little bit of time on it. Tom, we just said, in an up move, you've got low volume down bars, no supply tests, great place to enter. But occasionally, in an up move, the market will fall on very, very high volume on a particular day. And if they're bullish, it's a very strong sign of strength, even though the volume's high, correct?
Usually the high volume down bars, the spread needs to be a little bit narrow, it needs to close the middle, and the next bar needs to be up. And they use the bad news as a shakeout. It's only another maneuver to try to shake as many people out as possible, catch stops below the market, and panic those people that are long, encourage people to go short the wrong place, and so on and so on. It works.
Now, Evan just asked, when you've got, Philip, you might be able to answer this one, when you've got a gap down bar, narrow spread, is that the same as just having one big wide spread down, or is they're completely different things?
Yes, they are.
Different things. And
yes.
why is that?
Well, if you've got a wide spread down, there must be, it's starting at the top, and there's obviously a supply as you go down the bar.
Right.
If it's a narrow spread, it's gap down. If the spread is narrow, there must be buying coming in to support every sell order.
So it's almost
Hence
like
the narrow spread.
Right. So what you're saying, on the wide spread down, the supply's coming in.
Yeah,
but on the gap down bar, narrow spread, we're saying that basically, as the herd are massively selling, the professional money are just immediately buying it.
Yes.
It's
but on a wide spread, what's happening is the supply is coming in, and the demand is not absorbing it immediately.
Right.
Hence why you get the wide spread, and it keeps on falling. There's too much supply in there.
So really, if you see a gap down bar on ultra high volume after a declining price on bad news, that often will mark the bottom of the market.
Especially if it's a narrow spread, even better.
So the narrow spread is the key.
That's the key.
If we take one thing from this section here, narrow spread down bar, the spread is the capping. It's almost like professionals are so bullish at that point, they don't worry about testing it. They're just going to catch it. Okay,
we don't see it that often.
We saw an example last week, didn't we? I think it was Barclays or one of them. Yeah.
When you do see it, do pay attention to it. That is very significant.
Great, okay. Chris is just saying the ASX stocks often gap up or down depending on what the US market does. Of course they do. Oh no, Bob, I know that's not an error in volume. I checked it. I checked. That was not an error in volume. Trust me. It's on every single... I have several data feeds, just so you know. Bob Blake's question was, the volume was so high, how do you know that there's not an error in volume? I know because I go and check with different feeds. Now, I'm not saying they don't play around with volume. Indeed, Philip, you can talk briefly about this. I know in London they even admit it.
Well, it's actually, they actually issue the rules on how they do it. So that if you want to know, you can get, there's a book you can buy which explains how they do it.
Yeah.
And it's all related to the number of times what we call normal market size, which is the normal amount that you can trade in a particular stock at a guaranteed price with the market makers. And if you want to buy or sell more than that, they quote outside the price range.
Right.
And if they do that, they can quote anything, I think, up to certainly a day, if not 2 days later.
I'm often asked the question, you know, but if volume is so valuable, which we know it is, that would explain why the self-regulated exchanges hold it back as best they can.
Definitely, yes.
Is that right, Tom?
Yes, but don't forget we use relative volume. So the volume could be millions and millions out. But if you use relative volume, in other words, the volume you're looking at, you compare it, you can see it in a few seconds with your looking at it with the previous volume of, say, the computer uses 14 bars. And you could see clearly whether that volume is high or low or whatever relative to the previous volume. So the volume could be way out. It doesn't really make a lot of difference to us.
So that's a good thing. So basically what we're suggesting here is, and that would explain really why we're analysing tick volume in Forex. Now you're saying to me, and I know we've had this discussion, that once we've got tick volume corrected, they can't even fiddle with the volume at all. No. Even the exchange can't do anything.
No, it's activity.
And that's what we're working on. Okay, right, let's get to the final slide here on this session for quiz number 5. Okay, this was the NASDAQ, and it was a 9-minute chart that I actually traded. So Philip, could you talk us through A, B, and then what happened at C and D, then at E and F?
Right, well at A we've got what looks to me like a bottom reversal. As the first bar is closed on the lows, you notice there's been a big increase in volume there. The second bar is closed up towards the highs, and again the volume is fairly similar. Just looking at that, I can't quite see behind the A, but it looks as if the low of the second bar has gone slightly below the low of the first bar.
Yeah, it did, I remember
which is a bullish sign in itself. And it's actually pushed up through the high of that bar, although it didn't close above the high of the previous bar. Just looking at the 2 bars again.
Yeah.
So that's a bottom reversal, which itself is a sign of strength.
Yep.
Now at bar B, they've done some further buying. That's actually a down bar. You've still got very high volume in there. So they pushed it down to the lows again and bought it, and then it starts pushing up. Now when we get to bar C,
can I just stop you quickly, Philip? Evan asked a question. He says, will you always expect to see on a 2-bar reversal higher volume on the second bar, because there's 2 bars here, would that be important, or would it matter if the second bar had lower volume? I mean, I always look for higher volume personally because it's a sign of effort. But
here you've got very similar volume. There's two things you can look for there. On the down bar, I normally like to see more volume on the down bar than the up bar.
Okay.
But there's an exception to that, which is the one you were just pointing out, Gavin. If you manage to go up and close on the second bar above the high of the first bar, and you get increased volume, then, as you say quite rightly, that's effort.
Yeah.
And that's okay.
In this case, it closed within the body of the bar,
Yes.
so not quite, not a perfect example. The best one you'd ever see, as Philip said, is if it comes down here, and then the next bar goes out and pushes and closes above this bar on a bit of an increase in volume. That's a very strong sign of strength. That will show there's a lot of effort to push the market back up. And if it follows, it should be tested. Sometimes it doesn't get tested. It can actually mark a bottom and just keep going if you see those two bar reversals. So then what happens at bar C and D, Philip? We seem to sort of knock sideways a bit here.
We have. Well, bar C is showing a bit of a lack of interest in the upside because the volume's fallen off somewhat.
Yeah.
And then at bar D, you've got a bar which is close towards the middle, and you've got an increase in volume. So there's a bit of supply coming in, and that suggests they weren't quite ready to take it up at that point.
And of course then we get bar D confirming there that both these bars, C and D, were fairly weak. Now, when we see weak bars like this, Tom, often people get red signals and say, well, I'll short that, that's marked the end. Well, actually, this chart, and I know what happened to it, it went sideways, and I'm not going to show the actual chart, I'm going to go straight to the S&P when we come back from break, and we'll actually see that the market moves sideways. In this case, it moved sideways from this point D, which was at 9:30 in the morning, all the way through the afternoon session, until finally the next day, it finally moved back up. But we notice it did come back down and test into area C, and there was a trade. In fact, I took it, which is why I remember this chart quite well. But often, when you hit a point of supply, Tom, it just moves the market sideways. And sometimes, if the professionals are bullish, they'll hold the market up and then mark it up just like they did this Friday when we traded.
Well, the main thing is you've got a bottom reversal behind you. You've probably got, that probably marks the end of a down move, a bear market. So you've got strength right behind you, so you have to be careful. Now, admittedly, when you see these red bars, I can see almost here, I can't see the chart very well, but I can see loads of testing going on.
Yes.
I'm sure that's a test, there's all sorts of here. That's what's holding the market up.
Yeah, absolutely right. Alan Bowers just joined us. Hello, Alan. We're doing well, thank you. Everything's good. He said he overslept. He's a bit late. Good for you, Alan. Well, don't worry. We've recorded it. You haven't missed anything. So the time now. We've got another 10 minutes. So what we're going to do is we'll go now to start the questions. I'm going to break in about 10 minutes' time. So you can go and grab yourself a cup of coffee or a cup of tea, whatever you have, and then we'll have a 15-minute break. Okay, so we can all get our heads back together because there's a lot of information that we want to impart. Obviously, as we go through these questions, we've got quite a lot to go through. Okay, question 1 came in, and I'm not going to mention who sent these in, but you know that who you are. I attached 2 pictures of a good trade on the daily Swiss. So this is a currency pairing, a forex pair, showing the entry, middle, and exit. Okay, so this is not I particularly like how this chart was annotated as it happens, and I think it's been, I mean, looking at the trade, absolutely spot on. I think your entry was good. I think the way that you've managed the position there was good. You used the trend channel, which again we're going to talk a little bit about in a second. We're going to actually look at the Swissy and look at that. But something has to grab your attention to trade this pair. So he drew support and resistance, and he was using some moving averages and Fibonacci's. Nothing wrong with that at all. We do know 70 to 80% of our customers are using other things to confirm VSA. Rob Hoffman, our trading room, futures trading room guy, always uses things. Okay, and then we go create fib levels defined by Fibmaster. Okay, so he's using Fibonacci retracements, which we can see here, here, and here. Okay, look for a VSA setup on a rally. Better if a pattern has been defined. Okay, and then there's several things here that this particular customer's looking for, and then this was the actual trade, okay, that was taken to the upside, and then some weakness appeared up at the top here, okay, and that's where the trade was exited. But if you follow the trending system, we know that these currencies trend greatly. So let's actually go and have a look at the actual chart of the Swissy there. And I've used the 4-hour chart because I thought it would be nice to look at a bigger picture. Hello, Brad. Good to see you, buddy. We got Brad Bedford Brown in here. Okay, and let's look now here at what this chart has done on a 4-hour chart. So, number of things we've got that's very, very important that you can see on this chart. Okay, first of all, we're in a trading range and have been for some time, and I've marked the top and bottom. Here's your big rally, as we can see. I've left all the signals on here and the confirmation bars, and then because this is a 4-hour chart, the better probability trades, and I think this particular customer exited it around up here somewhere, but what we see is the market goes up to the top of these areas here. That's where your better probability trades are going to come, and you can see here on this bar one of Tom's signals we just talked about, the trap up move. Now, Philip, can I ask you about support and resistance, because we spend a bit of time talking about the bar formations and the background, but I know you use support resistance, Rob Hoffman uses support resistance, Brad uses support resistance, I use support and resistance. We don't talk about it a lot. Let's focus on here. We can see that when price action comes into a certain area, the setup probability to the low risk entry side is much greater. Can you just talk us briefly through how you use support and resistance and why it's so important and why it works?
Well, I use support and resistance very much, as you know, Kevin, the way you do. If you've got an area on a chart which has acted as resistance in the past, which is normally because you've got high volume bars in that area, then that's likely to act as resistance again, because if you've got an area which is acting as resistance, it requires effort to get up through it. And equally, if you've got an area which is acting as support in the past, that requires effort to break down through it. So if you see no demand as you go up into an area of resistance, it's not going to get up through there on low volume. It can't do. And equally, if you've got an area of support and you come down to that area of support and the volume is low, there isn't the effort there to break down through that support level. And this is, I think, why we notice this with trend channels as well. When we draw trend channels in, if you come down to the bottom of a trend channel and the volume is low, you're not going to break that trend channel.
Absolutely true.
It takes effort, and equally to go up through the top. And again, with your trigger numbers, that's why your trigger numbers work very well.
They work in all time frames as well, which is interesting. And the reason I picked the 4-hour chart here, and it's not, this is not a pairing I follow, but it's a pairing that was, we can see that we've got heavy accumulation, and it looks at the moment that top number there is acting as strong resistance, and now we're in no man's land. This is where a lot of traders get stuck. We're right in the middle of a place here and here. I would be looking, when this price action starts to approach this level here, that's where the volume is going to be really, really important. Now, Philip, what often happens, like, let me just take off the scribbles for a second. I hope they're helping. I'm just trying to focus a little bit on... let's just remove the scribbles. I can just erase that. And let's just have a look now at what happened on this bar here. Now, again, this is a trap up move, and it certainly was. In that 4-hour bar, the market again got pushed up. It's almost like they tried to catch the breakout traders. We get all these. There's lots of traders that trade breakouts and wonder why they get caught. And this, I think, is a really, really good example of why. Because if it's acted as resistance in the past, it's going to take some serious effort and then a test before they'll actually push up through it. Do you agree?
It is, and I'm looking at the number of times that level has already been hit. I mean, the two occasions that you've got to the left, I think it's hit it twice on each occasion, that level. So there's been 4 attempts previously, then there's another one just before.
Well, we can count them. Look. If we go backwards, look.
Yep, there's one.
You've got,
there's 5.
There's 1, 2 there. And we come back, and there's 1 there, look. Just here, look at the volume. Then you've got, there's no way it's going to go through there on no demand and an up thrust. I mean, if I took that line off, that would definitely be no demand. I'm sure, there, you see. So there is your, now that, of course, when it first gets hit, you don't really know much about it, but it comes back up here. Now we've got heavy supply coming in here. The volume isn't that high, but the next bar closes down and it just rejects it, look. Then they bring it back up. Now there you've got much more supply. And here, look, you've got no demand, okay, or weakness rather. It's not no demand, just a bit of weakness. But it's pushed up again on more volume. And then this time, they poke it through this old level to the left and mark it right the way back down. And that was a 4-hour chart. And I went and looked at the smaller time frames. And as we looked at the smaller time frames here, you actually got some very good entries. Now, look what happens when we come back down to support. Now, Philip, we teach people if you're going to take a trade, take it around the trigger number where you expect something to happen. But the problem is, and I'll tell you what the problem is, a lot of traders are in the middle here, sitting by their computer saying, I must trade, I'm a trader, I must trade. I learned a long time ago that actually over-trading is what kills their accounts.
Definitely, yeah. Patience, patience, patience.
Which is difficult sometimes for people.
It is, very
Tom,
difficult.
what's your thoughts on that? I mean, you've seen me trading this last week. You've seen me sit out the market several times. You saw the trading in New York. You saw some of the setups I've taken here. I've had one losing trade, which was the yesterday one, and we had a couple of other small ones. But overall, most of the time I've been sitting aside waiting. And is that what you advise people to do who are just...
Well, I described it recently as waiting for your bus to come along with the number on it that you're looking for. If the market's bullish, you're looking for a bus to come along that's got a test of the rising market on it. And that means that if you've got signs of strength behind you, remember, strength always appears on down bars when it appears. And if the market's marked down, especially if it's a narrow spread close to the middle and the volume is low, there is no supply present in that market. That means because the market definitely moves on supply and demand, if there's no supply, then demand must be greater than the supply. And that will then follow the path of least resistance and shoot up. So you do wait for those, I know you do. And of course you love to wait for the end of a rising market. Now admittedly you pyramid on some of these diamonds we've got, which is very good, as long as you've got support in the background.
You mean the diamond trending system, don't you?
Yeah.
I mean, if the market's moving in my favour and I see the trend holding, I actually scale into the position. That's correct.
That's good. So they call that pyramiding.
Yeah. Philip, same with you. I mean, you once you're in a trade, then you're looking to hold the trend. Tom's got that great trending system. I don't know if you use that as well. It's very simple, isn't it?
It is very simple, yes.
And if you go and look at last week's recording, I mean, really, I came out of a trade too soon yesterday because I didn't follow the rule. I saw something that was higher volume, and I thought, oh, I better exit, much the same as I did in New York. But if I'd have followed the simple trending system, I'd have got another 6 or 7 points out of the trade. But there we are. Everyone's slightly different there. But okay, so I think overall on the trade, the gentleman that sent that in, excellent trade. I mean, very well explained on there. You know, very, very good.
Good plan.
Hold on a second. I've got Brad just typing something in here. Hold on. Oh, Brad is here. Okay, Brad. All right, no worries. I'll take a look at that one shortly. We just want to keep the flow going here. So, but no, looking at the chart here, we can see that resistance, when you get unusual volume at those levels and you hit resistance levels, that's where your trade's going to come to the short side when they're confirmed. And of course, when we see back down at that old support level, which I've drawn here, look, here and here, we can see these are where you're going to be looking for this type of activity, which is little tests, okay, or as we can see here, stopping volume, which was actually confirmed on the next bar. Good. Right, let's break now. The time I make 9:30 a.m. Chicago, so we've been on air for an hour and a half. I'm going to break for 15 minutes. Part 2, we've got a lot to get through. We've probably got a good 2 hours in part 2. And then the final section will be questions and answers. So I hope you've enjoyed the first part there. We'll break now. We'll be back at 9:45 a.m. Chicago time, which is about 13 minutes. So we'll see you then. Hope you're enjoying it. And I'll put the next question up so you can see what we're going to be talking about.